Research at City Markets Edition.
Welcome to Research at City Markets Edition, where we break down global macro in 10 minutes or less. I'm your host, Adam Pickett, Citi's head of global macro strategy in London. And with me today is Giammarco Miani, my global macro strategy colleague, also based in London. Hi, Giammarco.
Hi, Adam.
We are recording this podcast at 9 a.m. on Monday, August 10th, 2026. We had quite a lot of different topics flying around in macro at the moment, called our last weekly macro Tapas as the playbook. And we want to discuss the global risk backdrop, Japan, the Fed, yield curves, and carry. So maybe if I kick us off on the global risk backdrop, from a top-down perspective, a lot of our risk metrics are pretty bullish. Cross-asset volatility is low. Citi's polls indicator has not hit 18. The generals, or at least the breadth of the top 7 names in the S&P 500, most of them are still above their 200-day moving average. Global data momentum is positive, and rising global earnings revision indices are positive and rising. We see little in the way for the time being to spoil the party, and the July payrolls print and a recently dovish Fed, we think ultimately mean that we're probably going to get a further dovish trajectory from here outside of a surprise in inflation later this week. But with limited wage gains, we've actually received the October 2026 FOMC meeting and also upgraded some of our bullishness in equities.
So on that, what about rates and semis spoiling the party for the S&P?
So historically, we find no strong relationship between the level of rates and the S&P. If anything, historically, higher rates have been good for equity returns. Clearly, the argument is more rate of change based. But when we look at Z scores of 3-month changes in rates, we need a substantially bigger sell-off than what we've been getting recently to upset the risk backdrop for equities. And obviously with recently softer data and a more dovish Fed, we think that can keep a cap on the yield move. On semis, we also did a whole host of analysis that really suggests you need a consistent bear market in semis to the tune of closer to 30% plus to consistently get a negative reaction in the S&P 500. So on both of those counts, we feel reasonably confident. That being said, we have a preference for equal weight S&P for the time being over the market weight, in part because of some of those sector uncertainties.
So you were talking about the Fed initially, and we obviously had the July FOMC where we continue to have this no forward guidance, very, very much, a wait and see Fed and a less communicative Fed. So wondering, how does that impact markets cross assets wise, but also how does that impact the US yield curve in particular?
Sure. So we got a steepening lately with the front end rallying, the back end selling off. Ultimately, we find that empirically to be bad for the dollar, good for high yield FX, good for EMFX carry longs, for copper, for equities, and even not bad for gold. So overall, this unusual but powerful twist steepening should in theory be good for the positive risk backdrop we talked about before. Our colleagues in rates have a preference for 530 steepeners, but overall, we think it's generally additive. While we're on the rates topic, Giammarco, a lot going on in Japan, both domestically, but also investors' interpretation of the global implications of the BOJ, the intervention, etc. What are some of your high-level takes there?
Yeah, so we've been calling for higher front-end yields for Japan. But I have to say, post the July meeting, the fact that we only got 1% was a little bit of a dovish signal. But then after that, obviously, we had this joint intervention, and the markets interpret that as a signal that the BOJ is effectively ready to do more to support the currency as well. So our economists actually are now calling for a bit of what you call a regime shift for the BOJ following the latest events. Their view is that, again, the quid pro quo for the US intervention was faster hikes from the BOJ. So they're now calling for a September hike, followed by another one in January, then June, and then December 2027 to then reach a terminal of 2%. So is that enough to stabilize the currency? We do think faster pace is probably needed to both compress rates differential, but also compress the term premium in Japan, which we think has been a clear driver of yen depreciation. So yes, obviously a faster pace would be welcome, but likely to stabilize the currency, we probably need something closer to a quarterly pace of hikes, which at this point, we're still not sure we're going to get.
Really interesting stuff there, Giammarco. So to wrap it up, how do you think we get a more durable surprise if September is already priced in, and in general, where do you see Japanese markets?
Yeah, we think front-end yield can move higher. A hawkish surprise is needed to stabilize the currency. If a September hike is enough, probably a quarterly pace, as mentioned, for the currency is vital, right? So we think yields can grind higher. The effects highly depends on the pace, and we're also constructive on the equity market.
Great. And outside of Japan, we've also seen some pretty amazing outperformance in FX carry. We've had a basket on, but we've been trying to play around with that. How do you look at the carry story for now, and what are we advising investors to do?
Yeah, so with respect to specifically yen and intervention, we have shown in the past that MFX carry does underperform following intervention. But when you look under the hood, what's happening, MFX long do okay. It's your short that cause carry to underperform. So a lot depends on your funders. Given the risk of further intervention, we think carry funded by maybe mix of G10 currencies can do better than your classic Asia funded baskets.
And are there any currencies outside of carry that we like at the moment?
Yeah, so good question. In Q2, I would say specifically that funding mix did better actually than euro dollar, than our carry basket fund in euro dollar. And then in Q3, also given the lower funding cost. With respect to other currencies that we like, stocky actually against euro, we recently added to our portfolio, which given our RECA models screened bullish stocky on rates differential, equities and CTOT.
Fantastic. So as a high-level overview, in risk, we're still bullish, but with a preference for equal-weighted S&P. We are fading the idea that the Fed can hike in October and have a preference for US curve steepeners. In Japan, we still think rates pricing can grind higher in yields, but without upsetting the local equity markets there. In FX, we still have a preference for carry baskets funding outside of Asia. We recently switched funding in euro and dollars to Swiss and CAD. We also quite like stocky as well. That just about wraps things up. Giammarco, thanks so much for joining us this week.
Thanks, Adam. Great to be here.
And thanks for you, the listener, for joining us as well. This episode was recorded on August 10th, 2026. I was your host, Adam Pickett. And for more details for the analysis, Citi clients can check out our reports on the Velocity portal. Next week's Research at Citi Markets edition will be hosted by Beata Mante, Citi's head of global equity strategy. And please be sure to watch out for our other podcast series, Research at Citi, which you can view on the same channel. The macro strategy team will be back in 2 weeks. Stay sharp.
This podcast contains thematic content and is not intended to be investment research, nor does it constitute financial, economic, legal, tax, or accounting advice. This podcast is provided for information purposes only and does not constitute an offer or solicitation to purchase or sell any financial instruments. The contents of this podcast are not based on your individual circumstances and should not be relied upon as an assessment of suitability for you of a particular product, security, or transaction. The information in this podcast is based on generally available information, and although obtained from sources believed by Citi to be reliable, its accuracy and completeness are not guaranteed. Past performance is not a guarantee or indication of future results. This podcast may not be copied or distributed, in whole or in part, without the express written consent of Citi. Copyright 2026 Citigroup Global Markets, Inc. Member SIPC. All rights reserved. Citi and Citi and Arc Design are trademarks and service marks of Citigroup Inc. or its affiliates and are used and registered throughout the world.